feeling buried under thousands of investment options. You're trying to build wealth with dividends, but every video throws a list of 10, 20, or even more ETFs at you. It's overwhelming, right? That feeling is called analysis paralysis, and it's the biggest thing keeping you on the sidelines. Well, not anymore. Forget those endless lists. You don't need a dozen funds to get started. You don't even need 5. In this video, we're cutting through all that noise. I'm going to show you a powerful 3-fund combo that can serve as a fantastic starting point for any beginner's dividend portfolio. Before we get into it, just a quick heads up. I'm not a financial advisor, and this is all for educational purposes. Investing always has its risks, so please do your own research. Okay, so why just 3 ETFs? Because it is a simple and powerful strategy. You get instant diversification across hundreds of great companies, the costs are incredibly low, and best of all, it is simple enough to set and forget. We were focusing on dividend growth. That means we were buying companies that don't just pay a dividend but have a long history of increasing it year after year. That is a powerful secret to building long-term wealth. Let's get into the first ETF on our list. The Quality Powerhouse, SCHD. First on our list is the Powerhouse, the Schwab US Dividend Equity ETF, ticker symbol SCHD. I like to think of this one as the all-star champion of the dividend world, and for good reason. SCHD tracks the Dow Jones US Dividend 100 Index. To get into this exclusive club, companies are screened for fundamental strength, looking at things like cash flow to debt, return on equity, and dividend growth. This means you're not just getting companies that pay dividends, you're getting high-quality, financially sound businesses. Let's talk numbers. The expense ratio is a rock-bottom 0.06%. That means for every $10,000 you invest, you're only paying $6 per year in fees. Historically, its dividend yield has often been in the 3.5% to 4.0% range. Inside, you'll find examples of reliable companies like Merck & Co., Amgen, and Coca-Cola. For a beginner, SCHD is the perfect cornerstone, giving you quality, yield, and super low costs, all in one. The Dividend Aristocrat, VIG. Next up, our second fund is the Vanguard Dividend Appreciation ETF, ticker VIG. If SCHD is the champion, think of VIG as the seasoned veteran with an impeccable track record. VIG's whole game is focusing on companies that have increased their dividends for at least 10 years straight. This is key because a consistently rising dividend is a huge sign of a healthy, growing business. It tracks the S&P US Dividend Growers Index. Its expense ratio is also incredibly low at just 0.05%. The dividend yield is typically lower than SCHD's, often hovering around 2%, but that's not the main point here. The focus is all about the growth of that dividend over time. In VIG, you'll find examples of dominant companies like Microsoft, Apple, and Broadcom. Adding VIG to your portfolio gives you a different flavor of dividend investing, one that prioritizes a long, proven history of dividend growth, which can lead to fantastic total returns in the long run. The Modern Core Builder, DGRO, and that brings us to our third and final ETF that rounds out this simple portfolio, the iShares Core Dividend Growth ETF, ticker DGRO. Think of this as the modern flexible core of your dividend strategy. DGRO looks for US stocks with at least 5 years of uninterrupted dividend growth. This 5-year rule is interesting because it can include some younger, faster-growing companies that might not make VIG's 10-year cut. It also smartly screens out the highest-yielding companies to avoid potential dividend traps. The expense ratio is an ultra-low 0.08%. For every $10,000 invested, that's just $8 a year. The dividend yield typically sits in the solid 2.1% to 2.3% range. As for what's inside, you'll find examples of household names like JP Morgan Chase, Johnson & Johnson, and ExxonMobil. DGRO is a fantastic, broadly diversified fund that acts as a perfect middle ground, capturing quality companies focused on growing their dividends. So there you have it, a simple 3-fund plan. You have SCHD, the quality powerhouse, screening for the strongest companies. You have VIG, the seasoned veteran, focusing on that ironclad, decade-long history of dividend growth. And you have DGRO, the modern core builder, giving you broad exposure to consistent dividend growers. Together, these 3 funds provide incredible diversification, a focus on high-quality companies, and a blend of both current income and future growth. You're covering all your bases, without the complexity. You now have a simple, powerful blueprint to kickstart your dividend investing journey. You can stop worrying about which of the thousands of funds to pick and start focusing on what actually matters, building your wealth for the long haul. If this video cut through the noise for you, do me a favor and hit that like and subscribe button. And I'm curious, drop a comment below and let me know which of these 3 ETFs is your favorite. For your next step, check out this video right here on how to actually buy your first ETF share step by step. Thanks for watching, and I'll see you in the next one.